Hello and welcome to this class on open market operations. Open market operations are central to the monetary policy toolkit. If the Federal Reserve decides to increase interest rates, then this could be achieved using an open market operation. What is an open market operation? We will see that an open market operation involves the sale or purchase of securities by a central bank. We will also see how this works in practice. We will discuss how open market operations directly affect the quantity of reserves in the federal funds market. We will see how these open market operations determine the equilibrium interest rate in this market, the federal funds rate. Remember, the federal funds rate is the main target interest rate of monetary policy in the US. Let's get started. Monetary policy involves choosing a target interest rate. This target interest rate will hopefully have an impact on the economy. This will allow the Federal Reserve to achieve its goals. The target interest rate of the Federal Reserve is called the federal funds rate. This is a short-term interest rate. In fact, this is the interest rate in the interbank market. Remember, the US interbank market is called the federal funds market. All banks have reserve accounts at the central bank. These reserves are called federal funds. An open market operation is designed to influence the federal funds rate. Roughly speaking, how does this work? Well, the Federal Reserve does not change the interest rate directly. Instead, by conducting an open market operation, the Fed changes the supply of reserves. The intersection of supply and demand determines the price of these reserves. That price is the same as the interest rate in this market. It is called the federal funds rate. Let's assume the Federal Reserve wants to decrease the interest rate. To achieve this, the Federal Reserve could shift the supply of reserves to the right. The new equilibrium features more federal funds, which will be traded at a lower interest rate. Open market operations allow the Federal Reserve to manipulate the quantity of reserves in the system. How does the Fed do this? Let's continue our example. Say the Fed wants to increase bank reserves. They could do this by giving banks more reserves in exchange for some securities. The bank would already own these securities and the Fed would have to pay a fair price. One more time. If the Federal Reserve wants to lower the federal funds rate, it can buy securities from banks. These purchases are paid for with reserves. Hence, the overall available funds in the federal funds market will increase. This shifts the supply curve to the right. The new equilibrium has more federal funds and a lower interest rate. Let's have a look how this works in practice. There are several steps. Step 1. The Federal Reserve's Open Market Committee, or FOMC, decides on the target interest rate. Step 2. By buying and selling itself is relegated to the Federal Reserve Bank of New York. They manage the Federal Reserve System Open Market Account, or SOMA. Step 3. The Federal Reserve Bank of New York's trading desk then purchases securities from the so-called primary dealers. These dealers have reserve accounts at the Federal Reserves. These dealers include the largest banks. What types of securities are usually purchased? Mostly US Treasuries. Step 4. When the trading desk completes a purchase, the Federal Reserve's balance sheet expands. On the asset side, we add the purchased securities, and on the liability side, reserves increase. These are new reserves that the Federal Reserve creates. Remember, the Fed controls the monetary base, so it is free to create these reserves. Here's an example of an open market purchase made by the Federal Reserve. On July 19, 2021, the Fed bought US Treasury securities with a par value of $1.4 billion. The securities had a remaining maturity of between 15 and 22 years. Here's a snapshot of the system's open market account portfolio from July 19, 2021. These were the domestic security holdings of the Federal Reserve System at this point in time. All of the securities are US government debt or debt guaranteed by the US government. The portfolio increased by about 100 billion relative to the prior week. The 2008 financial crisis marks a breakpoint in the way open market operations were conducted. The Fed reduced its target for the federal funds from 5.25% in mid-2007 to a range of 0 to 0.25% in December 2008. With short-term interest rates close to zero, simply buying more securities to increase reserves was no longer effective. New approaches were needed to stimulate a struggling economy. After the financial crisis, the aggregate supply of bank reserves was now larger than ever. This was a direct consequence of large-scale interventions by the Federal Reserve. This meant that open market operations would no longer be as effective in controlling the short-term interest rate. The Fed needed new monetary policy tools to deal with these problems. We will discuss these issues in a separate lecture. In this session, we have discussed open market operations and monetary policy. The key takeaways are: first, open market operations affect the supply of reserves. This, in turn, determines the federal funds rate, the Federal Reserve's target interest rate. Second, before the 2008 financial crisis, open market operations were the main monetary policy tool. Third, after 2008, with the supply of reserve have been elevated, traditional open market operations have been less important.